Hi, everyone, and welcome to the Zambezi Capital Quarterly Market Update. So we try to do these, after each quarter. So whether you're joining us for the first time live or watching a pre-record, happy to have you here. So as usual, we have a pretty packed agenda with different topics from the team to discuss here. But before we actually get into it, we like to reiterate that none of this is actual financial advice. This is purely for educational purposes. And so we do urge that before you do make any investment decisions, please seek out some professional advice. That being said, we are a team comprised of people who are super passionate about financial literacy, and that is exactly what we are here to convey. So without further ado, I will actually pass it off to Haggai, who is going to start us off with what's going on in the global economy. So over to you, Haggai.
Can you hear me, guys? Okay.
Oh, go ahead. Yeah.
Thank you so much. So I'm gonna just give a brief global update just with regards to what's happening to the global economy, covering mostly both emerging and developed countries. In the last quarter, is that there's been a lot of changes going on within the economy with regards to inflation, interest rates that are driving vision in forecasts between the last quarter and the previous quarter. The global GDP forecast has actually been revised up to 2.6% from the previous 2.2% for 2024, and it's actually expected to go to 2.7% in 2025. Much of this is driven by progress in the most developed economies, particularly the US, but also improvement in China. Inflation will continue to drive most of the discussion points with global policymakers and monetary policy generally when it comes to observing what's happening to the activities. What we have seen so far is that inflation has been moderating, especially in the US, and unemployment continues to be low. And that appears to be a most comforting thing driving GDP forecast to continue growing over the next few quarters. When it comes to the US economy, particularly, the US has been far more resilient. We are seeing a lot of discussion early on this issue of recession. There's the moderation in terms of resilient. We are seeing growth going positive, risk of soft landing. When it comes to the Eurozone, things to be a mixed bag. Companies that are doing well, especially in tech, has been driving much of the growth. The Eurozone has avoided a technical recession, particularly manufacturing heavy companies such as Germany, which continue to struggle. And as I said earlier, China growth continue to be improving, and that also has been a key factor in driving positive revised growth over the next few quarters. But before I talk about rates, because mostly rates are target mostly goes in line with inflation. And what we've seen so far is that inflation continues to fall. Major central banks actually have started to change the tone in their communication. Previously, references around upside interest risks have gradually been removed from the discussion and policy statements as we read, majorly in developed economies and some of the emerging economies. Discussions around downside risks remain there. And so the expectation is that interest rates will continue to be lower as we progress through 2024. But there's still a big question of how much will the easing go. We were expecting that actually, especially in the US, rates to be cut in the last quarter. But that didn't happen because inflation stubbornly remained pretty high. It increased in the previous, not the previous reading, but before the previous reading. So we'll continue observing that. And the graph that you're seeing there is just showing you how rates have changed across major central banks. We saw the peak in 2023, kind of going into 2024. What we're seeing right now is that the expectation that interest rates will continue being lowered as we go, in fact, more into 2025. And that cycle is actually easing, particularly in the Eurozone, where we are seeing central banks, particularly in Eurozone, Switzerland to be specific, and other economies in the UK, as well as Germany and France, are doing the same. Unemployment remains pretty low, except in few countries in Eurozone. And the last thing I have to mention around interest rates is that cuts have been quite very volatile because central banks are monitoring what's happening mostly in inflation. The story is pretty different when we talk about emerging economies, and my colleagues later on will touch on what's happening in emerging economies, particularly Africa and some countries in Latin America. But generally, what we're seeing is that rates will continue being lowered, but that will depend on what inflation will continue to be as we move forward. So that's an update on the global economy, particularly interest rates, GDP, and inflation. Thank you so much. Back to you, Mal.
Awesome. Thank you so much, Haggai. So we've heard about what's going on globally. So let's actually take a look at how our local economy is doing, right? So I'll pass it on to Wupe for an analysis of Zambia's macroeconomic situation. So over to you, Wupe.
Hi, Mal. Thank you so much. As earlier introduced, I will be giving an update for Q1 of 2024 specific to Zambia. So the first observation was that the Standard Composite Purchasing Managers Index was 49.2 in January of 2024. It then dropped to 47.3 in February, and thereafter closed at 48.8 at the end of Q1. Regarding inflation, as we all know, the Zambian government has a target of keeping inflation rate between 6 to 8%, as highlighted in the red band on the graph. However, for Q1, the rate of inflation stood at 13.2% for January 2024, and thereafter closed at 13.7% in March. So over the first quarter, the average rate of inflation was approximately 13.4%, which is notably well above the government's target. Moving on to the currency, we noted that the rate of depreciation of the kwacha against the US dollar moderated to 10.6% from 17.5% in Q4 of 2023. At the end of Q1, the kwacha was trading at 25.03 per US dollar compared to 25.78 in the last quarter of 2023. The monetary policy rate was raised by 100 basis points from 12.5% in February to 13.5% in March 2024 as an attempt to combat the rising rates of inflation. In terms of GDP growth, the growth prospects have been significantly downgraded from an earlier projection of about 4.4% due to the anticipated impact on the ongoing drought, especially on account of the impact that it's going to have on the key sectors such as the agriculture and energy sector, which are most likely to be adversely affected. So, as we all know, the country is experiencing a period of an energy crisis, well known as load shedding, which is highly affecting many businesses' productivity. So overall, we're hoping that the economy does perform slightly better at the end of the year. But for now, we do have a bleak outlook for the first quarter of 2024. This is all for Zambia. Thank you so much, Mal.
Great. Thank you so much for that update, Wupe. So moving on, we'll actually take a look at global financial markets. And so I'll touch on the US markets for a bit, and then I'll have Tafara touch on precious metals right after. So when it comes to the U.S. market, there's typically two indicators that we tend to look at. But first of all, why we typically tend to look at the U.S. market as an indication of what's going on. It's one of the biggest economies out there, and most countries still consider the U.S. dollar as a global reserve currency. So depending on how the U.S. performs, that will typically dictate how the rest of the economies will perform, with a few caveats here and there. So in 2023 and before, in 2022, the really big theme here was inflation, as Haggai mentioned, right? So we saw that worldwide. We're still struggling with it back home. So inflation levels, that we haven't seen in quite some time, they've started slowly coming down. They became the norm, and that also pushed the Federal Reserve, or the Central Bank of the United States, to raise interest rates up. Why? Well, there tends to be a negative relationship between prices and interest rates, right? So, for example, if interest rates goes up, that means that borrowing loans will get expensive, so people will be, kind of like reluctant to borrow loans, and then less loans means like less overall spending, with the whole goal to really just curb prices and bring those down. By looking at the chart, we can see that the CPI, or the Consumer Price Index, which is an approximation measure of the U.S. inflation, has come down over the last couple of months. Now, this doesn't mean that prices will magically turn around and start going down. No, this just means that price increases are slowing down. So those increases that we saw in the past are already baked in. The Federal Reserve, who basically sets the interest rates for the US, has been doing a relatively good job with interest rates. But the question on everyone's minds is, when will rates actually start coming back down? Now, there's a lot of speculation. However, it doesn't quite look like we're going to be seeing any rate cuts in the next couple of months. So, as Haggai said, probably in the last quarter of this year. But for now, the central bank or the Federal Reserve is kind of taking a let's wait and see approach, and probably no rate hikes, but no rate cuts as of yet. So that being said, the next indicator that we typically look at is the U.S. stock market. And for that, we focus on the S&P 500. So in Q1 of 2024, the S&P 500, which is the index that tracks the top 500 companies in the United States, has done around 10% growth, which is pretty phenomenal, given on average, the S&P does around 7 to 10% annually. The two sectors that actually drove most of the gains this quarter were the energy sector, which benefited from rising oil prices and increased demand for energy, as well as the tech sector. So, in particular, stocks such as Meta, Disney, Netflix, performed quite well in Q1. So that's just an overview of how the global financial market is doing. So I'll pass it on to Tafara, who's going to give us an update on how the precious metals markets is doing. So over to you, Tafara.
Thanks for that update, Mal. So good day, everyone. Like Mal mentioned, I'll be going over the market update for precious metals. Now, before we dive into the details, I would always like to start by sharing a quote. And this quote can never ring so true in a current environment. And this quote is by Jesse Livermore, which is, "No one ever went broke taking profits." And based on all the information and all the value add we've been providing here at Zambezi Capital through our market updates, now is a great time to cash in on some of the profits based on some of the recommendations I've been giving. So when it comes to the precious metals update, essentially, I do like to start by painting that picture. And the best place to start is the federal funds rate. So like Mal mentioned, the Federal Reserve of the United States sets a federal funds rate as part of their fiscal policy in order to control inflation. And they have held the Fed funds rate at 5.33% throughout Q1. Now, this steady rate plays that crucial role in shaping the economic landscape and influencing everything from borrowing costs as well as to investment strategies. So essentially, gold has been on an impressive upward trajectory, and it has reached new highs of $2,391 per ounce. Now, essentially, this is a significant milestone as it highlights the metal's enduring appeal as a safe haven in times of economic uncertainty. Now, a great relation that I've always told you, the weaker the dollar gets, that gold and the dollar people lose confidence in the dollar. Therefore, the more likely they are to seek out other assets as a hedge or as protection. And one of those assets of choice has been gold. So essentially, we don't see the dollar dropping significantly, but we do see gold there represented by that yellow line. We do see gold trying to go ahead and make new highs, whereas the dollar, it's not necessarily dropping, but it's in a consolidation pattern. And most analysis will tell you that that's basically like a bearish flag. So we are expecting bearish momentum on the dollar side, which will further support that thesis of gold, reaching higher highs. When we are comparing gold to any of like the previous quarters or the past, this chart definitely represents the gray areas represent recessions in the past. And as you've noticed, gold tends to rise in the times of recession. So this is the recession that, economics and analysts keep saying the recession that hasn't come or is yet to come. But we are seeing gold strengthening, precious metals as well. So drawing parallels from the past economic scenarios, such as the 2008 financial crisis, we can see that the Federal Reserve's low rate interest policy historically supported gold prices. While the current rate is higher, the economic principles of gold as a hedge still remain relevant. To conclude, I always love to give recommendations around ETFs. And these are some of the ETFs we've been tracking over the past market updates. And year to date, they're performing phenomenally with GLD. Year to date returns being at 13.21%. IAUM being at 13.12%. And then the short on the Dixie isn't doing that well. Like we mentioned earlier, the dollar is in a consolidation pattern. So the returns are negative. And then at negative 1.42. And then silver is doing phenomenally this year. It just went on a amazing bull tear, and it's at 28.14% SLV, the exchange traded fund. As we look ahead, it's crucial to monitor economic policies and the market dynamics as those will evolve, and those might change investor sentiment. So that's why I would always encourage you, if you did take any trades based on these recommendations or any investments, take some profits off the table and, leave your positions running, waiting for other opportunities for entry down the line.
Great. Thank you so much for that market update, Tafara. We've looked at what's happening globally as well as within precious metals. So we're actually going to go back to our local economy to get just an update on what's been happening in government security. So I'll just pass it on to Cedric to go over that section.
Hi, Mal. Thank you so much for that. Let's get right into it with the fixed income securities. So let's start off with bonds. And the beginning of the year was that there was an increased appetite and demand for bonds. However, it declined in subsequent months. And we see that from the graph presented on the screen, that January saw a very big spike. We had people willing to buy more than what was offered by the government. But come February and March, we saw a significant decline below what was actually offered by the government. And April continued that trend. Subsequent months have seen lower and lower demand for them. When you look at the shorter term fixed income securities from the government with the treasury bills, we see a very similar trend. It dipped as we moved towards February and showed that there was also less demand for what was being offered by the government then. But we saw it spike up as the quarter came to a close in March, which showed that there was somewhat of a moderate recovery. However, it then seemed to stagnate around that and even go below that. This could be attributed to economic uncertainty, such as drought affecting more of the investment alternatives, drawing investors to capital markets over the money markets. We see a continued decrease in the demand for government fixed income securities. And we are going to continue watching the markets and see if perhaps this is going to change. As of now, this is the current condition of our fixed income local security.
Awesome. Thank you so much for that update. And so just continuing with our current local economy, I'll pass it on to Daniel, who's going to give us an update with what's happening within the capital markets in Zambia.
Within the capital markets, we've seen a huge interest in terms of investor confidence. We're seeing an inflow or investors towards the LUSE rather than the traditional bonds that I think many Zambians have been most familiar to. Zambia is doing fairly well against the Egyptian Stock Exchange and the South African Stock Exchange, including India. Market lead in this space, which is the Nigerian exchange. So, and the Kenyan as well, which has been performing fairly well, and including the Ghanaian, where we saw a substantial increase looking at the year-to-date performance. This is just meant to complement the quarter one performance update that was highlighted by the CEO of the Lusaka Stock Exchange. And we're looking at right now, which is that 97 billion in terms of market cap on the LUSE. And that should be around 3.67 billion US dollars. So if we look at the stock performance during the past 12 months returns and the dividend distribution, we are seeing Pamozi having performed really well. In fact, just during the start of the year to date, this is remarkable. Zambia Sugar as well is also a good performer during the year, which we should also watch out for in terms of the retail or the food and beverage industry. CEC as well has been distributing quite significant dividends to its investors. Standard Chartered is also one of them, and including Chilanga Cement. There's also a stock watch that we also don't have to forget. A few picks for this quarter or this year in general would be Pamozi. Like we said, returns was really substantial. We're looking at 500% return. And if you're trying to tap into the consumer services industry and see remarkable growth, despite them not distributing any dividends, this is a good stock to look at. Then if we look at Standard Chartered, which has been performing quite well, and there's consistency in terms of combined growth and high dividend yields. If you're an investor who's trying to tap into the financial services industry, Standard Chartered is doing quite well in that end. Zambia Sugar as well, if you look at the food and beverage and tobacco industry, we've seen strong performance and consistency as well on its dividend yield. Chilanga Cement as well, quite solid dividend yield and decent growth expected to continue in the future, because I think people are still building, so we expect a lot of infrastructure development to continue. So this is also quite interesting. But a company that tops the list is Bata with the high dividend yield of 24%. If you want to tap into the fashion and clothing industry, I think it's been doing quite well in that regard, so which is the highest dividend yield. So this is appealing for, I think, many people who are looking for income-focused investments. So that's what we had for the capital markets update. Back to you, Mo.
Awesome. Thank you so much. Really interesting to see all those local assets performing really, really well. So moving on, I'll be covering the digital assets and crypto market space. So when we look at the crypto market, we typically focus on Bitcoin, since it's the largest digital asset out there and typically starts and ends all major cycles. So if we take a look at how Bitcoin has performed, it still remains one of the best performing assets over the last few quarters. So it surged around 68% in Q1 of 2024, almost reaching all-time highs. Now, of course, this doesn't always happen in a straight line. These assets are really volatile, and despite the gains they see, but I think it's safe to say that we are at the end of the bear market with regards to the overall digital asset space, and we could be seeing the start of the next cycle. So let's talk about some of the drivers behind this move. So the first one was the approval of the Bitcoin ETF. So after many months of going back and forth with the SEC, the first spot Bitcoin ETF in the United States was approved. And then after that, about 11 to 12 different firms launched their ETFs. So what this did was cause a pretty significant inflow of funds from institutions. So about 12 billion in the first month, and that number keeps adding up and keeps adding up. Now, because we have all of this institutional activity, trading volumes are actually up about 100% from the previous quarter, which marks basically the third best quarterly performance for Bitcoin over the last 3 years. So we've seen a lot more activity coming from institutions as well as retail. Looking at the market caps, it has surpassed the 1 trillion market cap. There's something very psychological about that 1 trillion market cap. That being said, it's still a relatively smaller asset when we're comparing it to things like stocks or bonds, fixed income, derivatives, and options, all that stuff. In comparison, it's still a small market, but the overall crypto space and Bitcoin has performed significantly well and is growing. And so with all this added institutional demand, prices rising up should draw in retail activity once again. We should see that market cap going up. So the second major catalyst was which actually occurred in April. This is just an event that we refer to that happens every 4 years. So just a quick recap and explanation about how this works. So Bitcoin is run on a blockchain, which is basically a decentralized distributed database. Now, because it's decentralized, there is no central authority to tell us, this is the current state. So it does need a majority of participants to all agree on the current state of the chain. And when I refer to the state of the chain, I just mean like with every block, we're able to tell this person has this much BTC, that person has this much BTC, this person sent this BTC over to that person. It's basically just telling us what the current balances for everyone's accounts, if you will, are. So you have users who use the network, but you also have miners who essentially provide processing power to the network in order to secure it. As a reward, miners who help secure the chain get rewarded with Bitcoin every single block. Now, the halving occurs every 210,000 blocks, which roughly is around 4 years, where the reward that's given to miners gets cut in half. And so it was 6.25 BTC as of April. As of April 20th, it's now 3.125 BTC. And every 4 years, it's just going to keep going, cutting in half every 4 years, which means less supply of BTC coming onto the market, making the asset a lot more scarce. And if we continue to see an increase in demand as we have over the last 2, 3, 5 years, that should, continue to push the price upwards. Obviously, like I mentioned before, it doesn't go up in a straight line. This asset is still volatile. It's still a small asset. And so drops of 30, 40, 50% are normal in this market. However, with that volatility comes the massive upside that we've been seeing. So Q1 has done around 68%. Those are really what drove the crypto market in the first quarter. But a little bit of a sneak peek for the next quarter, which everyone was actually expecting, is we actually got our first Ethereum ETF approved as well. So Ethereum is the second largest crypto or digital asset in the space, right behind Bitcoin. So Bitcoin aims to provide a stable monetary system, whereas Ethereum aims to be kind of like that virtual world computer with all these different apps running on top of it. So we'll talk about that more in the next quarterly market update. But we've been seeing a lot more institutional adoption occur in the space, a lot more innovation, and so this should be an overall net positive for the overall digital space. So last but not least, I'll pass it back to Daniel, who's just going to give us an impact and sustainability update and just wrap us up for the webinar. So back to you, Daniel.
All right, thanks again. So if we look at the impact and sustainability update, there are different aspects we've been looking at, or generally experts within this space look at. So that's environmental impact, social impact, which we've covered in our webinar as well, corporate governance, but there's also another aspect which is around resource management and brings us to the circular economy concept. So in this update, we're looking at it in the context of EV battery swapping and whether this can be a groundbreaking solution to just create a more sustainable industry within the automotive sector. So if you look at the circular economy, This aims to eliminate waste and promote the efficient use of resources. In this context, we're talking of EV batteries, and it involves maximizing the life cycle of these battery components through the use, refurbishment, and recycling. So battery swapping is like a key element in this model of circular economy, as it allows to efficiently exchange and reuse batteries and reduce this need of trying to manufacture new materials within that space, which obviously can lead to a lot of environmental negative impact. But to minimize that, we need to think around this concept of battery swapping stations for EVs. So the concept of battery swapping, this just is allowing a EV owner to exchange their depleted battery for a fully charged one. This is in a matter of minutes, so they still have the traditional charging option. And if you look at the battery swapping concept in itself, we're looking at challenges associated with whether your battery is depleted in your car or something malfunctions. So how difficult or efficient is it for us to switch? Is it cost effective? So battery swapping concept actually allows us to really create infrastructure and ecosystem to make it more efficient and cost effective in addressing some of these problems. So what we're seeing, I think Tesla get to in terms of their R&D and development is within the V3 supercharging, which is level 3 charging. So where you have to charge your car within lesser period of time than you would normally with the normal long charging times, which I think if you have to charge in very shorter period of times, there's also questions of degradation of batteries and all that stuff, which should be addressed. I think this also comes to how these engineers understand how either the options of battery swapping are more efficient. A use case in this that's quite interesting that I've sort of been investigating is within NIO's battery swapping and how that works. So if we look at its model, and this is where it's even allowing consumers to be able to buy an EV without even owning the battery, and they can subscribe to a service they call battery as a service or battery swapping service. The process involves obviously driving to a swapping station, and this is automated where the battery is replaced through robotics. Then the completion of the whole process is within 4 minutes, according to NIO's use case. And according to the cost of these battery swapping station, if we have to look at the initial installation of this, it's not as expensive as a filling station in comparison. But maybe looking into maintenance costs, such aspects like operational cost, that's also something we need to investigate to really get a full picture in terms of whether this is an efficient breakthrough in the EV solution. So if we look at implications of this in the sustainability aspects, we're looking at reduced downtime, quick swapping, making EVs more practical to daily use, and also for broader adoption, because I think for developing countries, they're highly dependent on second-hand vehicles. So if vehicles have to come and the battery malfunctions or deteriorates, it becomes expensive to really take it to the manufacturing plant and replace the battery. But if battery swapping stations are there and they cost significantly less and with less time, that means we have a way to really optimize the use of EVs. Unlike what we are having right now, where EVs die out their batteries and they just get dumped within these garages. So we need to also think through and have this conversation on a regional level as a continent, looking at the concept that we're trying to tap into this space and being part of the value chain or the supply chain. So we need to see how that. Then also extending the life cycle of the battery, right? Because now you're not forcing it to charge, and you really don't own the battery. You just swap quickly, and you don't worry about the whole degradation part, because that is a service in itself. You only worry about the monthly subscriptions for you using the various swapping stations. Then if you look at reduced waste as well, so you don't have a situation where an EV manufacturing company produces as many vehicles and they don't really recycle their batteries. They have to look at importing more critical minerals or mining more critical minerals to produce more new battery packs, which is really, really costly for society. Then if you look at resource efficiency, which I've also mentioned, and the carbon footprint, obviously, because you're using less imports from mining new materials, because you're recycling that. It also helps more have this principle of circular economy. So if you look at now a comparison between Tesla and NIO in various aspects in terms of business model, we have NIO incorporate not just the sale of vehicles, but we have battery swapping as a service. For Tesla, ignoring their other aspects, obviously with solar and all that stuff, which is part, but really sticking to the concept of EVs. For them, is just direct sales with integrated battery in their vehicles. Then if you look at swapping, NIO, there's an option for swapping that Tesla does not have. Charging time, obviously that's lessened. NIO's supercharging may take the same time as Tesla, but NIO also takes the lesser time due to the swap option, which is 4 minutes. But Tesla, within their assumptions, and I think as ARC has highlighted in most of their analysis, is that the charging times as battery technology improves, it will begin to reduce less and less. Since we don't understand the physics around that, we're just assuming NIO will be an efficient option in this case. Market focus, we're looking at urban for conveniency, because it's a busy region. So you're looking at where you don't really spend time like the way you do with the filling station, where 25 minutes would be so long, but 4 minutes you're back on the road would be, I think, very great. Then there's also a huge cost for Tesla for you to swap their battery, because you have to really take it there, and there's a lot of issues around that relatively to the option that NIO has. Then there's also the aspect of mass adoption, which I think I didn't include in the presentation, but the concept is that NIO is now getting to from the luxury aspect of producing EVs to reducing the cost of production, to making vehicles that many people can be able to afford. With what they currently have, we're looking at half the cost of what has been produced so far in terms of EVs. So there's one mass adoption model that they are working on, which we expect to see whether that will live by the standards in the next few quarters. Then infrastructure, we know that right now the Chinese infrastructure of battery swapping is much more advanced than any other part of the world, but we're seeing Europe come into this market as well. Then Tesla has an extensive charging network, so that's not the worry in terms of supercharging for Tesla. So a few recommendations for Zambia, looking at the feasibility study that was done in terms of manufacturing EV batteries, and this turned out to be successful, is that we need to look at several things that I think we might be missing out. Is what infrastructure do we need to have so that we are preparing on one end that in the next 10 to 20 years, and not just adopting this whole sector just because it's like the energy transition, and we reduce that hype of really focusing on pushing this agenda, but we also look at how sustainable is the infrastructure that we're adopting to really sustain what we are trying to achieve. So a few recommendations would be establishing partnerships and leveraging, I think, a partnership with the Chinese market, and necessarily understanding this in terms of the infrastructure, gained expertise in terms of battery management systems, which is, I think, the main focus. Then also regional collaboration. How do we get this conversation in terms of a regional collaboration to create this network of either if the battery management system of establishing swapping stations would be a good idea. We can do that. On one end, we're producing the EV batteries. On the other end, we're preparing the market and the infrastructure for this EV mobility and sustainability. Then also public awareness and training, because at the end of the day, battery swap stations are like filling stations, require a high level of training. So people have to understand how to operate these robotics materials and computers and program them. So there's need for people to be aware in terms of how EVs actually function and whether battery swapping stations will complement the infrastructure for EVs to thrive and really have this mass adoption and quicker adoption for markets like ours, especially like tariffs in China is experiencing tariffs in the US. So they're also looking at tapping into other regions, and they've already expanded into Europe. Would Africa be the next option in a few years from now? So we need to also look at that. So what programs are there as well to build local expertise in this space? It's quite important to look at that. So Zambia had this high quality development forum between China and Zambia. It was interesting because I think we had the presence of the president being, oriented to the whole Chinese development agenda and our relationship with China, and why now we need to focus on high quality development. Because I think there was also a conversation through social media where people are saying, this relationship between China doesn't make sense because there's poor quality development in terms of these agreements that we make. Everything else equal, we think it's more to do with, I think, understanding the magnitude of this whole sector for us to really know what we are signing or the contracts we're getting into. And I think our partnership and this forum will be a platform that will provide an excellent way to discuss and advance these initiatives. And doing well for the whole battery supply chain and EV market in general, and fostering this whole sustainability and creating jobs is one of the missions that I think, new jobs in this case. So that's new skills as well that we require. So that's it we had for this segment. Thanks.
All right, thank you so much. So that brings us to the end of our quarterly webinar. So we hope you enjoyed gaining this insightful information. And once again, we'd like to remind everyone that these webinars are for educational purposes, so not financial advice. So if you do wish to invest based off on the information we present here, please reach out to a financial advisor before you actually do. So as mentioned, we are a diverse group who is very passionate about financial literacy and financial education. And on behalf of Zambezi Capital, I'd like to thank you all for joining in. So see you next quarter.